Wanna shake that ground.
Hi, everybody. This is Paul Hitchcock with the estate and asset protection planning firm Barth Calderon. Thanks for jumping on Wealth Protector TV, and some of you may be listening on Wealth Protector Radio. Here with my colleague Brad Barth, who is one of our experts in estate and asset protection planning and a top speaker across the country to many incredible groups, including Vistage, Tiger 21, the California Apartment Association, and many others. Brad, can you hear me okay?
Yes, thanks, Paul. Hi.
Yeah, so what we're talking about today, Brad, I know you talk about a lot in your workshops. Really important is planned charitable giving.
Right.
And so I'm just going to dive right in. And my first question is, what is it, who does it, and why?
Okay, well, first of all, Paul, I want to say thank you for giving me the opportunity to share this important message. This is one of those favorite things that I love to talk about. And I think it's a very important message. Just as an aside, having been doing estate planning for 21 years now, I always find that people are charitably inclined, but they just don't know how to give, right? And so what I'm talking about is that when you're doing estate planning, when I typically ask them in the course of the distribution of their assets among the beneficiaries, do they want to give a certain dollar amount or a certain percentage to a charity? And then it always spurs a lot of conversation, and then it normally leads into a conversation. Well, we've been giving during our lifetime. I don't want to take necessarily money away from my kids or my grandkids or my spouse. How do I do this? So I always like to spend a few moments in educating people on the various tools and techniques of charitable planning. So I know that you and I have talked about doing this particular presentation before in the past, and so I'm just very, very happy that we're able to accomplish this. So in a nutshell, what charitable planning is, and I say it's very different than charitable giving. Charitable giving is those circumstances where you get the red kettle, the Salvation Army red kettle as you're walking out of the grocery store. That's a charitable gift. Or the Fireman's Fund, or there's a fundraiser that's happening, or maybe you're giving for a particular event, or alumni reached out to you. That's kind of I call those one-off gifts. And those are gifts that could be $25, maybe National Public Radio, $100. They're relatively modest gifts. Now, for those individuals who are doing charitable giving as part of an overall financial plan, and we're going to talk about some of the tax aspects to it, the dollar values may be a little bit larger. But when I get to the discussion between charitable giving and charitable planning, it's where you change the $100 gift to a $100,000 gift, right? And that's ultimately what charitable planning is all about. What are the various tools and techniques that we're able to create very large, substantial gifts to help the general public welfare without necessarily taking food away from your own immediate family and your own immediate needs?
Yeah, because Brad, when you bring that up, I mean, as a novice, I say that sounds kind of scary, because you're talking to people about giving away a lot of their money, and I say to myself, who do people really want to give away their money? And,
right.
And if the kids are involved, the kids start barking.
Right.
Say, wait a minute.
Yeah.
So I mean, but it is a big deal. People really do this.
Yeah, it's a great point, because think about this. I always say for every action, there's an equal and opposite reaction, right? So if you're giving $1 to charity, who are you not giving that dollar to? Your kids.
Right.
And they get a little upset with me when I start giving hundreds of thousands of dollars or millions of dollars to kids. They're like, what are you doing to me? Yeah. Don't worry, we got you covered. Again, this is where a more comprehensive charitable plan kicks in, and it certainly isn't done in a vacuum. When you start getting to some of the higher levels of estate or financial planning and how charitable planning fits into this, it is done, with a more comprehensive look at. So your point is very, very well taken. But I think with proper analysis and proper planning, it's one that can be readily remedied. Right.
So is it, when you say, so my question, part of it was, who does it? Is it only for millionaires and billionaires that get involved in this, or who's the target for this?
I'm heavily involved in a lot of charitable organizations, and you find people from all over the spectrum, from those that have literally the hundreds of millions of dollars, more money than they could ever spend, and they truly are philanthropists.
Right.
Then you get people that have more modest means, but they really want to make an impact on the community, something that touches their heart. Maybe they're doing something in memory of somebody. And I think it goes into the question of who gives, right? I mean, who are the type of people that give? Well, you got those that are motivated by tax benefits. So it's just purely a matter of economics. You know, I'd rather, if I have to give to a social welfare, right? If I have taxes are social welfare dollars. You get taxed, it's going to go into the public dole, and then the government is going to basically disseminate those dollars to the general public. Okay, well, if I have to give up my money for the public benefit, I'd rather have some control over where that social dollar goes as opposed to where the government. So some people do it purely as a financial planning thing. If it's not my money, at least I can direct at least where part of my money is going from the tax man. You get those that truly are just heavily involved in a charitable purpose, whether it's a religious organization, whether it's an educational, maybe it's maybe like the Heart Association, Red Cross, maybe it's a university, maybe it's a particular type of research. I mean, there's many reasons why people give. Wildlife funds. They're doing it because something touches their heart. You get some people give because they really have nobody else to give to, right? Take, for example, a client, who may be the last of their family to survive. So
Right.
they outlived their spouse, right? Maybe they never had kids, or they outlived their kids for some reason. They don't have any sisters or brothers. Many a times, especially nowadays, you get people living into their 90s, 94, or they may be the last person in their family to there. So the natural people you would think that would receive kids, parents, brothers, sisters, nieces, they don't do it. So this way they wind up giving to charity.
Okay.
I think
also, when do you have this discussion? I mean, do you start the discussion when someone's on their deathbed? Now, I know the answer to that, or does it start when you're accumulating wealth? I mean, what does that?
Yeah, that's another really good question. I mean, I always have the conversation with my clients during the course of the estate plan. There's a natural time when you're asking who gets your stuff when you pass away. You can inject. Some people are very involved in tithing and giving to the religious organizations.
Right.
Some people already have a habit of giving. I normally ask, have you been the last 5 years or so, have you taken any charitable deductions on your tax returns that you would want to see continued if you yourself couldn't do it? And it doesn't only happen upon somebody's, to use your words, deathbed as part of an estate plan. Sometimes people want to continue giving during their lifetime, even if they themselves cannot. And I'll just use myself as a perfect example. I'm heavily involved in my religious community, and I give on a monthly basis. And I know that my synagogue is dependent and reliant on the source of funds that I help to provide. And if I myself am unable to, because physically, let's say I'm incapacitated, forget passing away, I'm just incapacitated. And so long as I'm financially able to do so, I want those gifts to be continued to be made on my behalf. And so it isn't just a matter of who gets your charitable contributions when you pass away. Sometimes it's part of a lifetime plan, as well as during periods of incapacity. You want to make sure that those provisions are in there as well. So I don't think there's ever a wrong time to talk about it. As I mentioned, I think most people are generally charitably inclined. I think it's just a matter of they need to find out how to give.
Right.
Yeah.
Well, one of the things you mentioned is tax benefits. I want to explore that a little bit because, as you and I were talking offline, the tax benefits apply to income, capital gains, estate tax.
Right.
And you said, oh, that's one of the motivations why people give. So talk a little bit about the tax side of all this.
Okay, so I'll take it in that order. I think you said income, capital gains, and estate. We'll kind of take it in that order. I want to preface this discussion by saying I'm not a CPA. Okay, let's start with that. And whenever we do more in-depth charitable planning, we always team up with the tax advisors because it's a necessary discussion. We are the instrumentality of doing it, or the advisors, but we want to make sure we work with proper tax counsel and competent tax counsel in this area. And I say competent because not all CPAs know the rules. There are certain people that specialize in this area. Okay. So from an income tax perspective, I think most people have enough general knowledge to know that there's a thing called an income tax charitable deduction. It's typically a line item on your 1040, and I think even now under the new Trump law, even if you do have a general deduction, I think you can still itemize charitable contributions. So now that also depends though on the type of charity you're giving. You got the type of charity and the type of asset. Some charities are public benefit charities like the Red Cross. Some of them may be private foundations, and so the percentage of deductibility is different. There's an amount that you can deduct during any particular year, and if your charitable contribution exceeds that allowable amount, it gets rolled over for a certain number of years. So a large contribution can impact your taxes over maybe a 4 or 5 year time period. And also the type of asset. The type of deductions you get for things like cash are very different than for things like, like a couch, tangible personal property, or maybe appreciated assets. So it's a combination of the type of charitable entity, the type of asset, and also your overall adjusted gross income as to how much you can take in the 1 year. So that just kind of plays into, if you get a charitable deduction, an income tax deduction, that actually means more money in your pocket. And so some people think of it like, I'm actually giving money away, I'm worse off. No, it's weird, because you give money away, you actually have more money because Uncle Sam takes less of you at the end of the year. So it's kind of a weird way of thinking of things. That I give money away so I can make more money. Right. More my money, right? So that's the income tax side. On the capital gain tax side, we're going to talk about some of the devices that we use a little bit later on in this webcast. And one of the devices that we use are what are called charitable remainder trusts. And we'll talk about that. And that's one of the primary tools that we help to use to, I don't want to say completely eliminate capital gain tax, but you certainly can minimize it and amortize it. So I'm going to save that conversation on capital gain tax for when we get to that point later in the webcast. Okay. Very powerful tool, not only for creating a source of income, but we work with a lot with business owners. The substantial majority of our client base are business owners, and sometimes they want to have an exit. They want to have a sale. So as a matter of fact, you can even use these types of trusts as part of an exit strategy from your business, which is very, very cool. Yeah, and we've been dealing with a lot of the Amazon sellers who are preparing their businesses for exit, liquidity event. This issue coming up. Perfect example of it. And then the last tax category you mentioned was estate. And this is what a lot of people think about, as you mentioned, when you pass away. What's the tax implications of me giving my stuff away? Well, right now we're dealing with a very large estate tax thanks to the Trump law that came into effect as of January 1st, 2018. And so a lot of people really aren't impacted by the estate taxes as they used to be several years ago under the Bush and Obama years, because the exemptions were lower, which means you more quickly had a taxable estate. And when you give stuff away to charities upon your passing, you typically get a dollar for dollar exchange. So if you had $100,000 of a tax, an estate tax, and you gave $100,000 to a charity, that netted out to zero. So you had no capital gain, you had no estate taxes. So here, if you were to use gifting as part of an estate plan, which we do quite frequently, that's another way how you eliminate estate taxes. So back to the general tax benefits of charitable planning, as you properly identified, there's income tax benefits, there's capital gain tax benefits, and there's estate tax benefits. So it could be used during lifetime, it could be used during sale of assets, it could be used upon your passing. And many times for most clients, it's a combination of all three of those. Very powerful tool. Very powerful. Yeah, no, great. Well, I know we're jumping into some strategies in a minute here, but just before we get there, you have the great line here, as you and I were talking about, is give with your head and your heart. No. So as opposed to just ad hocing things. What is the deal with that? Right. Yeah. What I say is giving with your, giving with your head, not just with your heart. I think that's kind of how I label it, because most people just you have the love for the little kitty cats you see on TV. So you start sending them $9 a month, whatever it is, that touches your heart, right?
Right.
But it goes back to the ad hoc. That's an emotional pull. Well, rather than giving the kitty cat $9.99 a month, how about giving them, like I said, $99,000, and yet still not having that a negative impact on your overall financials? Again, it goes back to a charitable gift as opposed to a charitable plan. I always say you're giving with your heart. That was the gift. Someone talked to you, they spoke with you, they touched an emotional string, and you gave. You opened up your wallet. But when it gets to your head, you're planning with your head. Now you're talking about charitable planning, and it's not just so much the ad hoc one-offs. Now you're talking about more comprehensive estate tools, financial planning tools, or charitable planning tools. Yeah.
All right. So we've kind of established why people give: for tax reasons,
Right.
because they have charitable intent, and the reasons to give, based on your head versus your heart. Now we get into giving strategically, and these are some of the tools
Right.
that we use. So let's jump into that. I know the CRT is one of those, but what are the tools?
Okay. So some of the basic tools, let me pull up some of my notes over here, because I know that I want to make sure I don't miss some of them. And I'm going to be sharing a slide with you when we get to the more complicated ones. I'll take over the screen here so I can screen share with you. But I call this the 6 key gifting strategies, and they are outright gifts. There's bequests via your estate plan. There's gifts of life insurance policies, gifts of retirement plans. There's the charitable remainder trusts, and then there's wealth replacement trusts. So these are, again, from the most simplest, a little bit more to the more complicated. And by no means is this an exhaustive list. This is the most common stuff that you're going to see. Now, everyone is familiar with outright gifts. We've been pretty much talking about that. Again, the Red Kettle, the Salvation Army, the Fireman's Fund, or whatever it is. That you just drop some money at the coins at the grocery store and you're checking out. That's straight up outright gifts. Some stuff you keep track of, some stuff you don't keep track of for reportings, but it's, again, very simple. If you happen to give a university as $1,000, the church wants to $1,800, you give $1,800, whatever it is. It's very, very simple outright gifts. You get they're normally for public benefit organizations. You normally get the maximum 50% charitable deduction against your income taxes. And like I said, very simple, very easy. Again, that's the ad hoc giving, right? That's the giving with the heart stuff. The next one is bequest with estate plans. I think most people are familiar with this too, right? A lot of people are they're into tithing, right? They normally would give 10% of their earnings to the church or religious organization, or they'll give to the Wildlife Fund or the Susan G. Komen or Cancer Society or Red Cross, Salvation Army, whatever. Wounded Warriors, it goes on and on. And they would list them as a beneficiary in their will or in their trust, in the testamentary documents. So most people take, for example, a traditional tithing of 10%. You would say, upon my passing or upon the passing of my surviving spouse, 10% goes to the church, 90% is held for my kids, right? Very simple. And that would be done either through a will or through a trust. The nice thing about that type of gift, it was 2 nice things about it. First of all, it doesn't cost you anything during lifetime, right? It's a testamentary gift. So it has no impact on your retirement or your needs at all during your lifetime. And so long as you're alive and have capacity, your estate plans remain completely modifiable and revocable. So if another charity touches your heart, or you don't like the charitable direction that your chosen charity is getting involved in as far as maybe political activities, then you may take them off the list, right? You start with University A and it winds up being University B because they're more in alignment with what your current needs are. So that's your typical bequests. And by the way, my job is to help clients find the source of funds. So now we're getting into a couple of very unique tools that people forget about. One of them is life insurance policies. Now, for those of us that have life insurance, many of us, like myself, have a younger family. I have a lot of life insurance because I'm also the main, income earner in my family.
Right.
So if I pass away, I need to make sure I have enough money to take care of my wife and my young family. But if my family grows up and they're successful individuals and out of college, but yet I'm still holding on to this, $3 or $4 million life insurance policy, well, I don't really need $4 million because all my kids now it did its job. They got past that point. So now I got this very large asset that I'm paying relatively modest premiums on. It's not dollar for dollar, it's dollar per thousand of death benefit, right? This is a great way where you can list a charity as a beneficiary. So here again, you can list a charity as 10%, 20% on the beneficiary form, and your family and your trust again as 90 or 80% beneficiary. So it's a great way to create a very large gift for relatively modest dollar values because you have insurance that you no longer need. You had it for a purpose, no longer need it. I use this also with our business owners. They'll have an insurance policy which is funding a buy-sell agreement, some type of cross-purchase buy-sell. They sold the business, and they're sitting here with a $10 million life insurance policy. Again, they're paying a relatively modest annual premium on it, but they can leave a substantial gift through life insurance. Cost them nothing during lifetime, obviously, because life insurance doesn't pay out until the insured passes away. It doesn't have to be everything. You can still, through the beneficiary form, you can allocate percentages. And again, you can always change it. No need to call your lawyer. No need to modify your estate plan. You just change the beneficiary. Easy peasy. And a very unique tool about that also is that if there's even a way where we can do a little bit more of advanced transfers of those life insurance policies, so that when you're making a premium payment on a quarterly, monthly, annual basis, that can become a current present income tax deduction. Deduction. So when you're paying the premium to a life insurance policy that you effectively gifted to the charity, you're now every premium payment you're getting a charitable deduction against it. Again, some lifetime benefits of doing that.
So that could be an immediate benefit from that particular strategy.
That's right. And everyone benefits in the long run. And I spent time talking about the the beneficiary and life insurance, because now the next source and probably the most readily available for most people, this is a tool that I use. Retirement plans.
Right.
People have retirement plans. They have 401ks, 403bs, they have IRAs, SEPs, Simples, you name it, they have it. And absent you Rothing it, and there's trillions of dollars tied up in retirement assets. And absent you Rothing it, people for us like here in California, we haven't paid state income tax on those dollars yet. Nor have we paid federal income tax on those dollars yet. The whole idea about the incentive to save for retirement is pre-tax dollars, tax-free growth. We only tax you when it comes out. Right. So they're wonderful wealth accumulation tools. And I see clients' final statements that got large retirement assets. But from an estate planning point of view, they're terrible wealth transfer tools, because there could be these pitfalls. And we've talked about this before, Paul, as far as the blow-ups of these potential retirement assets and the tax burdens that it can create on families because they haven't paid the taxes yet. So if you're looking at a retirement plan that says, hey, I got the $1 million in my retirement plan, I'm like, no, you don't. What you got maybe is $500,000 to $600,000 because you got to pay the tax man back first. Right. But if you list a charity as a beneficiary, going back to our hypothetical $1 million account, or I mean, more realistically, it's about $500,000 401k plan. If someone passes away, if you list your kids as a beneficiary, they're going to get the net of the tax. But if you list a charity as the beneficiary, they're going to get the full $500,000. So it's a way of taking a tax-riddled asset, federal income tax, state income tax, and giving it to the charity. Because think about this, when you pass away, the kids are going to get other tax-advantaged assets. They're going to get a step-up in basis on the house. They're going to get cash dollar for dollar. They may get life insurance, income tax-free. All that stuff is tax-advantaged. But you got this one crummy tax-riddled asset, the retirement plan. That's the one where we can make a huge difference and give that to the retirement. To the charity. Let the charity get the tax riddled asset, and your kids can get all the tax advantaged assets.
But what if the kids start barking at this because it's a big number? I mean, it's like, okay, well, wait a minute. You know, there's 4 kids in the family. They have their own kids with college expenses. They're like, every penny counts for us.
Yeah. Well, then in the case like that, you go back to a couple of things. One, are there other sources of funds? If a client's only assets retirement plan, again, you don't want to take food out of the kid's mouth, right? You're looking at the totality of the client's financial plan. If they're going to get a large inheritance on a property, there's plenty of cash there, they're getting a couple $1 million on life insurance, then the retirement plan is a great asset. It's not to the exclusion of the other plans. It's using it with that. And just like I mentioned on life insurance, with retirement, you can list multiple beneficiaries. Okay, 10%, 20% of the retirement goes to the charity, tax-free. And then after tax will go to the kids. It's just one of those assets that we like to use. Again, it costs you nothing during lifetime. You don't disinherit your spouse, right? It's only when you and your spouse pass away, at that point, not affecting your retirement, that point the charity kicks in, costs you nothing during lifetime. And here again, you can change the beneficiary willy-nilly. No need to call your lawyer. No need to modify your estate plan. You just change the beneficiary form. Another excellent, excellent tool that I use probably more than anything else in this type of planning is with retirement assets.
Okay.
All right. So now I want to talk about the charitable plan. So those were the easy ones. Outright gifts, simply listing a charity as a beneficiary in your plan. The insurance policies, retirement assets. Oh, one last thing before I move on to the charitable trusts is that when it goes to your plan, people all have different intents of why they want to give. So rather than just saying, oh, to the Red Cross, which would wind up in the general fund perhaps, some people say, well, I want it to go to a particular purpose. In your estate plan, you have the space to be able to say for what reason.
Okay.
It could be used like, I want to give to the church for the purposes of building a preschool. I've had some people give to universities, a particular school within a school of music within the university, a particular type of research, the Cancer Association, but a particular type of cancer or a particular. So in the state, one of the benefits of the estate plan is that you can really spell out what you want to do, and you have some fiduciary, whether it's an executor or a trustee, to help make sure that that specific purpose is listed. Otherwise, it goes into the general fund, and it may wind up going to the charity's administration, and a lot of people aren't so happy about that. They normally want it to use for some particular purpose. Okay, so now with the easy stuff behind us, I want to talk about one of my favorite vehicles. I know I said that the retirement was favorite, but this is also a favorite. What can I say? I love this topic. Okay, I'm going to take over the screen here, and I'm going to share something.
Yeah.
All right, let me kind of just, let me see if I can get this fired up here. Whoops, wrong one. Let me kind of, give me a second here, Paul. Let me just get over to the types of tools that we use. Okay, here we go. All right, we already talked about this. This is the giving strategically.
Right.
All right, and so here we had outright gifts, bequests, life insurance policies, etc. What I want to get to is this one here, the Charitable Remainder Trust. And it's kind of a very unique tool, and it has to do with the creation of a trust. And that's what this box is right here. This is a trust. And this is a very specialized trust. It's called a Charitable Remainder Trust, which means there's a charity who's the back-end beneficiary. They are the charitable remainder beneficiary, not your kids,
right?
Charity. That's what's important to remember in this particular case. We do have variations of this, but this is the general idea.
And this is a trust you set up, you draft.
Yes, that's right. This is more of an advanced. You want to work with a professional on this. This is not pull off the internet stuff. This is more advanced planning. But you would take an asset, and typically we use this as a highly appreciated, underproductive asset. And the various example I use is simply a piece of real estate. Let's say a retired person, someone who's a little bit older. They have bought a piece of property that they're renting out. They bought the property 30 years ago for $30,000, and now it's worth $1 million. Okay, the highly appreciated, but
Right.
they're only getting $4,000 a month in income. You see what I'm saying?
Right. Right. Yeah.
You have a very highly appreciated, underproductive asset. Somebody who's a little bit older, maybe, well, it doesn't have to be, but in my example, a little bit older, they could really use more income, but they can't. They're afraid to sell the property because they're going to get clobbered in capital gain taxes. You got this huge growth of $970,000 in my example. So what you can do is you can take that highly appreciated, underproductive asset, put it into your charitable remainder trust, and because the charity is on the back end, the trustee sells the asset. You got to be willing to sell the asset. Okay, it's important. When you sell the asset, now you've created $1 million bank account. It's not $1 million less capital gain. You got to avoid, at least for the sale, you avoided the capital gain tax.
Right. Total value goes in there.
The full value goes in there. And the reason why is because this trust has a charitable beneficiary. I call this a charitable partnership. You're going to get benefit today by not paying capital gain tax by having a charity on the back end. Okay, so what does all this mean? You create the trust, and then number one, donor funds the trust. You take the highly appreciated asset, you put it in the trust. Because it's a charitable trust, now you get an income tax deduction, right? So you get a present income tax deduction, which goes back to our opening comments: nature, who the charity is,
right?
The type of asset going in, and your adjusted gross income, how long it goes out for. So you get an income tax deduction, and then that immediately increases your income. And then it produces an income. Now the money is in a brokerage account that's producing an income, the full $1 million.
So you can take that $1 million and you can invest it and diversify it
right
the way you want, working with
right.
a professional, and kick off the income.
And that income comes back to you. It comes back to you. So back to my example of the retired individual. They were only getting $4,000 a month, but they don't have long-term care insurance. Maybe they don't have enough money for their retirement. Maybe they want to help pay for their grandkids' college education. Maybe they want to take a trip around the world. It's your money. Do whatever you want with it. So what you do is you put the money in the trust sells it. You get a present income tax deduction, and you get an income stream. I'm going to share with you on the next slide, an income stream. And then when you pass away, whatever's left inside this trust right here goes to over here, step 3, goes to the charitable beneficiary, okay?
So Brad, this gets into, as far as making the donation, it can be highly appreciated asset, it could be stocks, it could be property, can it also be a business, right?
Yeah, you bet, that's right. And that's one of the ones that we use here, the example. So thanks for bringing that up. So some clients, let's say they're going to sell the business, okay, and they say, "Well, I'm gonna have a $10 million windfall on the sale of my business. I'm going to get clobbered on capital gain tax. I started my business for $1,000. I'm going to sell it for $10 million. You can imagine the capital gain that's going on here. So if you take the full business and you put it inside the CRT, the charitable remainder trust, I'm going to show you there are some limitations as to how much you can take out. There's limitations the government puts in because the intent is that on the back end, there's supposed to be some money left over for charity.
Right, it can't go to zero.
Yeah, you just can't put $10 million in, sell it, and take $10 million out and escape capital gain tax.
Right.
It's designed to pay out over your lifetime, and there's something designed to go to the charity. I'm going to give you the illustrations in a second. So there's limitations on what the person gets back. And some people are like, listen, I got my one windfall. I want to have my mad money. I don't want to deal with these scheduled payments per the government's prerequisites. So I say, fine, let's just use maybe 50%. Maybe we'll take half the business, we'll put it in the CRT, and half the business you sell. So the half that you sell in your name, you pay the capital gain tax, you get your $3 million net, whatever it is, and you go crazy with it. No limitations, no whatever.
So you can do that. So if you're selling a business, you can break it up and just put half of it in the CRT?
That's right. And then what happens is then the part that's in the CRT, you then sell The other half, 5 million, you would sell with no capital gain tax and get an income over the remainder of your lifetime. So it's a little bit of a balance. Every client, I've done it 70-30, 30% CRT, 70% takeaway. I've done it the opposite, 70% CRT, 30% takeaway. It's just a matter, again, of the overall financial analysis. You cannot do this type of planning without having an understanding of the client's overall financial needs.
Well, yeah, because as you're talking about this gets into, okay, big picture, advanced planning, financial planning,
Yes,
and how you're allocating these pieces. And somebody could say, okay, it's great, let's carve off half my business, sell it as CRT. Right. I'll live on the income, and then you can even replace that money, which I think you're going to talk about here, in the CRT with an insurance policy.
That's right. That's right.
So there's a lot of strategy.
There's totally flexible. That's right. And as I mentioned when my first comments is, this is never done in a vacuum. We always have to do this in light of a financial analysis. So that's absolutely a good point. So what I want to show you here is we do wind up using, as you mentioned, a wealth replacement trust. I'll get over this in a couple of minutes. So this kind of show you how the circular transaction works. So the donor creates this charitable remainder trust. They fund the assets in, right? The assets go in.
Right.
They get a present income tax deduction that comes back out to them. The donor gets the income tax deduction, and the investment portfolio, and in our case, our full $1 million, no capital gain tax, our full $1 million is now generating an income monthly, quarterly, semi-annually, and however we set this up, typically it's on monthly or quarterly, is now being paid to the donor. So we've created this circle transaction. But as I mentioned to you, because it's a charitable remainder trust, if I put $1 million in, what did I say earlier? That for every action, there's an opposite and equal reaction. I said, if I'm putting $1 million into a charitable entity, who's not getting the $1 million?
Your beneficiary.
The kids, right? So sometimes we don't want to disinherit our kids for the benefit of the charity. So as you correctly mentioned, many times we use a life insurance policy. We put it into into their trust. And how much insurance do we buy, Paul? The $1 million that we otherwise gave to the charity. So if we disinherit our kids for the benefit of the charity on one side, we simply replace that with $1 million life insurance policy on the other. And people say, well, wait a second, but I'm older now. It's $1 million is expensive. That's where the income over here, the income being generated from the CRT, is used to supplement the cost of that life insurance policy. And I'll show you in a second. So effectively, the insurance winds up costing you nothing because we've created this income producing machine that pays the insurance policy, and you're still gonna have money left over for your retirement, long-term care, college, trip around the world, etc. Very
interesting. And let's say you put a business in there and, and you sell half or all the business, whatever it is. Then you have the wealth replacement trust. Is there an analysis of what type of life insurance goes in there? Because are you building up then cash value life insurance in the wealth replacement trust?
Yeah, no, typically this would be either, it depends on if there's a surviving spouse. Maybe it could be a second to die policy. It could be an individual policy. It could be term. It could be whole life. There's all kind of variables based upon age, type of assets, with economic needs.
Okay.
Yeah, so again, getting back to our team approach, you got legal. That's me helping design the estate and the advanced charitable plan. You got the financial planner, making sure all this stuff works within their overall financial and retirement needs, part of the exit planning as well. And you got the insurance professional to find out what's the best way for the insurance to work if we're using that as a wealth replacement tool.
Right.
So that's why I'm saying you don't pull this stuff off the internet and just do it, because as you can see, I said this was the more complicated, it's the most powerful tool that we have, but at the same time, it does take a bit more of a comprehensive approach. But I don't think that this is over most people being able to understand. It's just, it's a little foreign for some folks.
Right.
So effectively what you're doing here, my example, we took a house and then you have to sell the asset. The house is sold, right? That's the machine that creates the income, okay? That income is then used to buy the life insurance policy. And that's how everything stays while for the remainder of your lifetime and the remainder of your surviving spouse. Sitting on the back end over here is the nonprofit. Nonprofit is really getting nothing during your lifetime. Nothing. All the deductions and all the income are flowing to you or your spouse during your lifetime. Okay, lifetime. They are the charitable remainder beneficiary when you die. And you got a life insurance policy that's sitting over here doing absolutely nothing until you pass away. When you pass away, those life insurance death benefits go to your kids to replace the wealth of the house that you gave away. See how it fits together?
Right.
Okay. So I did this analysis for a client of mine. This is 2016. The numbers are off, but the concept is the same. So here we took a $1 million asset. That was the fair market value of the asset. We put it inside our CRT. I'm getting an income on this portfolio at 5%. Okay, well, this is hypothetical, but just 5% income. Here is my donor's deduction. Remember, 10%. You get a 10% charitable deduction. We put in $1 million up on top. We get a $100,000 charitable deduction. So that now goes on our present income, our 1040, and rolls over for 5 years. So again, you're getting immediate income tax deduction, which means more money in your pocket. Now, the cool thing about this is right here. One of my favorite things to show is this. Here on year one, we start with our $1 million. We have our 5% growth, which is my principal income. Now, you have to distribute a certain dollar amount per year per the IRS schedules. And my client was what? How old are they? Oh, 65 years old. I have right here. So per the IRS schedules, my 65-year-old person is going to live 17 years.
Right.
So I got a 17-year payout, and we're paying this out quarterly. You see this? So quarterly for 17 years, this is the distribution of year one. Look at this, Paul. $193,000 will be distributed to the client year one.
Year one.
You take out a little bit of capital gain tax. You take out a little investment. There is some tax that comes out, but the lion's share, $193,000, comes out in year one.
Yeah.
Back to my little old lady. She's got a $1 million house. That's giving her $4,000 income. She doesn't have long-term care, doesn't have retirement, wants to pay for kids' college. Look what we did. We created $193,000 in year one, capital gain tax-free from the get-go. And now the remainder for year one, after she makes her deduction, is $853. So her opening balance in year two is $853. It's earning 5%. So now in year two, she's going to have a withdrawal of $164,000.
Jeez.
And then look at year three, 5%, $140. It's a decreasing amount because you're taking money out. But if you look at the numbers, 193, 164, 140,000, 120,000. If you go down over the full 17-year time period, based upon the calculations, she's going to take out $1.2 million of distributions when she started 17 years ago with only $1 million.
Right.
Because it wasn't, she got to avoid the capital gain tax and it got reinvested over time. The tax bite never quite caught up with her. So this is what she gets during her lifetime.
Amazing. I mean, it's
totally incredible.
Yeah.
And this goes back to, I was telling you, yeah, but she's 65 years old. $1 million policy is going to cost her $30,000 a year, Paul. Okay, right. Great. Look what I generated. I generated $193,000. If I pay the $30,000 insurance premium, she still is going to walk away with $166,000.
Right, right.
It works.
Yeah, yeah. The numbers add up.
The numbers add up, right? Now, I told you also that it's a charitable remainder. So what happens if she dies at any time during this 17-year time period? This is the remainder category. So say, for example, she says she gets so excited over the first handful of years, she then has a heart attack and passes away, God forbid, right? You gotta laugh about these things.
Right.
So let's say it's year 6. So she passes away in year 6. The amount of money still sitting in her bank account at that time is $386,000, right? Because remember, she took these distributions right here, right? She started with $1 million, distribution, and year 6, her remaining balance in her brokerage account is $186,000. When she dies, that's what goes to the charity. So she now left a $386,000 legacy to her charity or charities of her choice. Okay.
Amazing. Yeah. No, it's fantastic.
Yes. So getting back to my example over here. So here, remember our donor put that property inside, $1 million property, sold it, turned it into cash, created our engine, which creates these distributions. Okay. During her lifetime, she dies. Now she dies. This over here in green is what goes to the charity. That's what drops down. But when she dies, the life insurance policy also turned into cash. So the remainder from the charity goes down to the nonprofit. That $386,000 goes down to the nonprofit. You see that?
Yeah.
And then the kids, they get the full $1 million from the life insurance policy.
It's pretty amazing. I mean, it's amazing. Yeah. It's just,
yeah, think about it. The kids live in New York. They say, Mom, I don't really want your house in Southern California. I'd much rather have $1 million income tax free from a life insurance policy than to deal with this old rickety broken down house in Southern California for $1 million. When you look at this, Paul, I call this a win-win-win.
Right.
Everybody wins here. The lady in our case won because she turned a highly appreciated, underproductive asset into an income producing machine for her, right? She wins. The charity wins because they got a large charitable deduction, in my example, on $386,000, whereas before she was giving them $36.
Right.
See, now planning with your head and not with your heart, right?
Yep.
And the kids win because the kids got the $1 million asset, income tax-free and estate tax-free from the life insurance policy to replace it. And if you think about it, Paul, in most of my clients' case, what did Uncle Sam got? Uncle Sam got nothing. It wasn't a complete estate tax-free. So that's win number 4. She wins, charity wins, kids win, government gets nothing, we all win.
There's a loser in there, but we don't care.
This to me is the most powerful arsenal that we have against the modern attack on the accumulation of wealth, period.
Yeah.
This is it.
And I've heard you talk, Brad, when you're sitting down with clients, and you kind of briefly mentioned it, the way to look at this, for anyone that's watching this show is it's a big picture analysis.
Yes.
It's looking at all the pieces, and it's almost like an architect going in and building something. You got to look at how everything fits together. Is this right? And and carve it up. And it just seems to me that's kind of the right way to do it.
Yeah. So you hopefully you can feel my enthusiasm coming through the screen here, because charitable planning is just such an important component. I think not only for an individual, but also for society. And as I tell my clients, when you get taxed, income taxed, capital gain tax, investment tax, estate tax, it's not your dollar. It's social dollars.
Right.
The government takes it and applies it to the social welfare. It's not your money. It's social money. So the question is, do you want to direct the social dollars, or do you want Uncle Sam to direct the social dollars? And charitable planning allows you to take those dollars, that tax dollars, and directing them in the direction that's important to you.
Right.
You can see there's so many benefits to doing this type of work, and it doesn't have to be at your cost. It's not a one-way street. It's not just you give, and you and your family suffer because your heart is bigger than your head.
Right.
This allows the opposite. You benefit too because of what you're doing with the charitable partnership.
Love it. As usual, great information, Brad. Thanks so much. And thanks everybody for jumping on. I know this is a little bit longer than our normal ones, but well worth it. Great information. And of course, as always, don't ever hesitate to reach out to us if you have questions about anything you ever see here. Happy to help you get the right answers. So Brad, thanks so much.
My pleasure. Thanks, Paul. Great topic. Okay. Bye-bye.
Bye-bye.